Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This is where you get everything you need to know in 90 seconds at 9 o'clock, with news that borrowing from banks apparently stunts growth. But first, today's US Federal Reserve Monetary Policy Review was a tame affair as they issued another no-change wait-and-see statement. They have marginally lowered their internal forecast for US GDP, their unemployment rate, and inflation forecast relative to their March analysis. But the analysis also showed that they are forecasting 25 basis points hikes in 2015. Given there are only 4 more such reviews left this year, markets seem to need to prepare for a September start to their hiking. These interest rate rise signals are coming as they acknowledge international developments. No doubt the main one is the Greek situation, and policymakers across that region and even in Greece are now actively preparing and talking about a Grexit. Overnight, their central bank warned of painful consequences, and their Prime Minister said he was ready to take the consequences. The day is now close where someone says the game is over. In the meantime, weird analogies are being expressed, often about cows. Check the link below. Back in the real world, the OECD has said governments should limit the amount banks can lend to households and cap the pay of top-earning male executives in the finance sector if it wants to avoid another financial crisis. It said its research shows that bank loans slow growth compared with credit provided by other market sources such as bonds and equities. They also say bank loans cause misallocation of capital by funding investments with low profitability, magnifying the cost of implicit guarantees for too-big-to-fail banks, drawing highly talented workers away from sectors with greater productive potential, and generate boom and bust cycles. In China, there are signs their housing market troubles may have bottomed out and they are on the mend. At least that's the view of one major analyst. Back in the US, their Congressional Budget Office has put the spotlight back on the long-term costs of funding an aging population. It says that although federal deficits have shrunk markedly in recent years, under current law, increased spending for Social Security and major healthcare programs, along with increasing interest costs, will cause their debt to rise steadily over the long term and faster than overall economic growth. In just another 25 years, US federal debt will be more than 100% of GDP, growing and clearly unsustainable. Back in New York, US Treasury 10-year benchmark yields rose today following the Fed statement and now at 2.37%. US oil markets are pretty much unchanged, with the US benchmark price just under $60 a barrel now, and Brent crude is now just under $64 a barrel. The gold price is up a little, however, now at $1,182 an ounce. The Kiwi dollar has started to rise following the Fed statement. This morning it opened by pushing up over 70 US cents. It is also at 90.2 Aussie cents and has risen to 61.8 euro cents on the Greek woes. The TWI is at 73.4. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.